picture this. It's midnight. You're lying in bed. The blue light of your phone is just illuminating your face in the dark, right? Because, like so many of us, you're scrolling through real estate listings.
Oh, yeah, the midnight doom scroll. We've all been there.
Right. And you click on this one house listed for $500,000. $500,000. And you're probably expecting, I don't know, a nice wraparound porch, maybe a renovated kitchen.
You'd hope so for that kind of money.
But no. No, it is a 1,200 square foot box. The kitchen has those peeling laminate countertops from like 2003. The carpet is this highly questionable shade of beige.
Oh, I know the exact carpet you're talking about.
And there is literal fake wood paneling in the basement. Yet the listing agent, with just absolute audacity, is calling this a charming starter home.
And that midnight scrolling session usually ends with you doing like panic mental math on your salary in the dark, right? Just trying to figure out where you went wrong in life.
Exactly. You're lying there wondering, did I miss a massive promotion? Did my invitation to the wealth class get lost in the mail? Or has the entire housing market collectively just lost its mind?
Well, spoiler alert from the source material we're looking at today, it is not you, it's the math.
Yep, and today we're taking a deep dive into this incredibly eye-opening financial analysis by Nick. It's titled, The Brutal Math of a $500,000 House.
And our mission for this deep dive isn't to look at, who a bank will legally approve for a loan. We're looking at who can legitimately, genuinely afford a $500,000 house in 2026.
Right, without turning their everyday life into a total financial stress simulator.
Exactly. Because qualifying for a mortgage and actually being able to sleep at night after you sign the paperwork, those are two very, very different financial realities.
Yeah, that midnight anxiety you're feeling, it isn't just in your head. It's a completely rational reaction to the current baseline. Because a $500,000 house just isn't a mansion on a hill anymore, is it?
Not even close. In dozens of U.S. markets right now, $500,000 is the absolute floor.
Wow.
We're talking about places like Denver, Austin, or honestly anything within commuting distance of a major metropolitan area.
Basically where the jobs are.
Right. $500,000 is what perfectly normal people are expected to somehow come up with for a perfectly basic 3-bedroom, 2-bathroom house with a yard the size of a beach towel.
Okay, let's unpack this because to really understand that baseline, we have to look at the very first mathematical wall you hit before you even get the keys.
The down payment.
Exactly, the down payment. The gold standard everyone always talks about is 20%. And on a $500,000 house, that is $100,000 in pure cash.
Which brings us to the first major disconnect in this analysis. If you look at the median American savings account, it currently holds about $8,000.
Wait, $8,000?
$8,000.
That means the average person isn't just like stretching to reach that down payment. They are $92,000 short. I mean, how is a normal household supposed to bridge a gap that massive?
Well, let's run the actual math of trying to save that much. The median household income in America is around $84,000, right?
Okay.
So if you are making that median income and you somehow miraculously manage to save 10% of your gross income, which, by the way, is incredibly difficult when rent, groceries, and basic utilities are eating up most of your paycheck.
Oh, absolutely.
But let's pretend you do. You are saving $8,400 a year.
So if I'm saving $8,400 a year and I need $100,000, I mean, I'm looking at nearly 12 years just to save the down payment.
12 years. And that is assuming home prices stay completely stagnant for over a decade.
Which they never do.
And historically, we know they won't.
It's like you're running a marathon, but the starting line just keeps moving backward while you're running. You get a raise, you save a little more, and suddenly that same 2003 laminate countertop house is now $550,000.
Exactly. It's a moving target.
So I have to imagine people just give up on the 20% rule entirely, right? They scrape together maybe $25,000 or $50,000 and just put down 5 or 10% instead.
The vast majority of buyers do exactly that. They bring a much smaller down payment to the table. But what's fascinating here is how the financial system penalizes that reality. Bringing less than 20% triggers PMI.
Ah, right. The dreaded private mortgage insurance.
The source frames PMI brilliantly, actually. Not just as a standard banking fee, but essentially as a poverty tax.
A poverty tax? Wow.
Yeah. It's a financial punishment for the crime of not being wealthy enough to drop $100,000 in cash. You're hit with an extra $200 to $400 every single month.
Just evaporating into thin air.
Exactly. And the kicker is that this insurance policy doesn't even protect you if you lose your job.
Wait, really? It doesn't?
No, it exclusively protects the bank's risk. They are worried you might default, so they force you to pay the premium for their safety net.
Hold on, though. Let me just push back a little bit here.
Yeah.
Is putting 10% down really that catastrophic? Like, sure, PMI is an annoying fee. I get that. But if you have a solid, stable job, surely the monthly payments on a $450,000 loan aren't that bad. I mean, people buy houses like this every day.
Well, a lower down payment doesn't just trigger PMI.
Oh.
It leaves you with a much larger loan principal, which cascades into this bloated, multi-layered monthly cost. Let's break down the anatomy of that bill.
Let's do it.
So you have a $450,000 loan at current interest rates sitting in the 6 to 7% range. Your basic mortgage payment, just the principal and the interest, lands right around $2,750 to $2,850.
Which is already more than rent for a lot of people.
Oh, easily.
But obviously, that's just the loan itself. What about the other required costs? The taxes, the insurance? Because those aren't fixed numbers, right?
Far from it. First, you have property taxes, which can vary wildly depending on where you are. But conservatively, let's add about $500 a month.
Okay, 500.
Then comes homeowners insurance. And the source specifically highlights that insurance premiums have skyrocketed recently due to climate change.
Oh, right. Because of all the severe weather.
Exactly. As extreme weather events become more frequent, insurers are just raising rates across the board. If you are anywhere near a flood zone, a fire zone, or tornado alley, you're looking at another $250 to $350 a month easily. Let's just call it $300.
Man. And then there's the part of homeownership that always seems to catch people completely off guard. Things breaking.
Yep. Maintenance.
I know there's a standard rule of thumb for maintenance.
Yeah.
But what does that actually look like on a $500,000 property?
So the general financial rule is to budget 1% of your home's total value per year for maintenance and repairs. On a $500,000 house, that is $5,000 annually.
So divide that by 12.
Broken down, you need to be setting aside about $417 every single month.
Here's where it gets really interesting.
Yeah.
Because you never think about that $417 until the water heater explodes at 11 p.m. on a Sunday.
It's always a Sunday.
Right. It's never a convenient Tuesday afternoon. It's always a weekend emergency plumbing raid or like the AC dying in the middle of a July heat wave. So you absolutely have to have that cash ready.
Right.
Plus, we have to factor in that $300 poverty tax we talked about earlier.
Right, the PMI. So stacking all of that up paints the true picture of affordability. $2,850 for the mortgage.
Okay.
$500 for taxes.
Yep.
$300 for insurance. $417 for maintenance. And $300 for PMI.
So what's the total?
Your total monthly housing cost is now roughly $4,367
Over $4,000 a month.
every month.
And that is best case scenario. That's assuming your local neighborhood HOA board doesn't randomly decide to, I don't know, repave the entire subdivision and send you a surprise $3,000 special assessment bill.
Right. And to put that $4,300 monthly payment into perspective, we really have to look at the rules financial advisors use for affordability.
Like the 28% rule.
Exactly. The classic rule dictates you shouldn't spend more than 28% of your gross monthly income on housing. If we reverse engineer a $4,367 payment using that rule, you would need to be making roughly $187,000 a year.
Okay, wait, but what about the banks? Because I feel like banks approve people for much larger loans than financial advisors would ever actually recommend.
They absolutely do. Lenders use a much more lenient metric, often approving a total debt-to-income ratio up to 43%.
Which feels dangerously high.
It is. But even at that maximum limit, literally stretching your budget as far as the bank legally allows you, you still need an income of around $150,000 annually just to qualify for this basic $500,000 home.
Wow.
And the brutal punchline from the analysis is that only about 10 to 20% of U.S. households actually make $150,000 or more.
That means 80% of American households mathematically cannot comfortably afford a basic $500,000 house under any reasonable standard.
Not without massive stress, no.
That is a staggering reality check. But clearly, I mean, houses are still being sold. So let's look at that top 10 to 20% who actually make that kind of money. If they buy this house, Do they get to live the American dream?
To answer that, the source profile is a hypothetical but very mathematically rigorous family. Let's look at the Johnsons.
Okay, let's meet the Johnsons.
They are two working professionals pulling in a combined $160,000 a year. That puts them solidly in the upper middle class, well above the median. On paper, society tells them they should be extremely comfortable.
It sounds like a great income, honestly.
Mm.
But what happens when that $160,000 hits their bank account in the real world?
Well, a gross income of $160K shrinks very, very quickly.
Taxes.
Yep. After federal and state income taxes are deducted, along with mandatory FICA payroll taxes for Social Security and Medicare, and maybe a very modest contribution to a 401k retirement plan, their actual take-home pay is around $9,500 a month.
Okay, so they have $9,500 in cash to work with for the month. And the first thing that comes out is that bloated housing cost we just calculated.
Right. $4,367.
Man.
Instantly leaving them with $5,133 for literally everything else in their lives. They are spending 46% of their take-home pay on housing alone.
I can hear people listening to this and thinking, hey, $5,000 left over still sounds like a lot of money. But let's actually drain that bucket by living a normal, modern suburban life.
It goes fast.
It does. The Johnsons both commute from that suburb, so they have 2 car payments. There goes $800. Car insurance for 2 vehicles, another $250. Gas, because they live in a sprawling area that probably isn't walkable, $300.
Don't forget the student loans.
Right. Because they needed those college degrees to get the jobs paying $160K in the first place. Conservatively, that's $600. Health insurance premiums, $400. Groceries for a family trying to eat decently, let's say $800. Utilities to heat and cool that bigger house, $450.
And once you subtract those standard, unavoidable living expenses, their remaining cash for the entire month drops to exactly $1,533.
And out of that $1,500, they still have to buy clothing, pay for kids' activities, cover medical copays, handle inevitable car repairs, and somehow build an emergency fund.
This specific breakdown really illustrates the deep, chronic psychological toll of the math. The Johnsons are the anatomy of what it means to be house poor.
House poor, yeah.
Having $1,500 to cover all the variables for a whole family means you are checking your bank account before every single trip to the grocery store. It feels like sweating a $35 field trip for your kid because the check engine light just came on in the sedan.
Oh, man, that is so real.
It means if your teenager needs braces, you are financing that dental work on a payment plan like you're buying a Honda Civic.
It's the anxiety of lying awake at 2 a.m., wondering if you can stretch those bald tires for just another month and just praying it doesn't rain.
Yeah.
They're literally one unexpected expense away from a total crisis.
Exactly.
If the HVAC fails, that's $5,000 they simply do not have in cash. If someone rear-ends them and the insurance deductible is $1,000, that expense is going straight onto a credit card with 20% interest.
They own a house, but they can't afford to live in it comfortably. They are essentially prisoners in their own home, working constantly just to pay for walls they're too stressed out to even appreciate.
Which raises a really terrifying question for you, the listener.
Mm-hmm.
If a household making double the national median income is one broken air conditioner away from a financial meltdown, what happens to the family making the actual median of $84,000?
Honestly, at an $84,000 income level, buying a $500,000 house isn't just tight, and it isn't just a financial stretch. It is a mathematical fantasy.
It doesn't work.
It is entirely impossible without massive external help like inherited family wealth or accepting a level of debt risk that is borderline dangerous.
So if the math is this disastrous, right?
Yeah.
If even the upper middle class is drowning in this scenario, why are people still buying? Why is everyone walking around acting like this is perfectly normal?
Because we are caught in a systemic trap driven by a fundamental mismatch in the economy. The data shows that home prices have increased roughly 400% since 1990.
400%.
Meanwhile, median household income is up only about 180% in that exact same period. The cost of the asset has completely disconnected from the reality of wages.
400% growth in housing costs versus 180% growth in wages. That encapsulates the entire crisis right there. But, nobody mentions that historical context when you're touring an open house.
If we connect this to the bigger picture, you have to realize the mechanics of the real estate industry. Nobody involved in the transaction has a financial incentive to tell you that you're about to drown in debt.
That's a good point.
The seller wants the absolute highest price possible. The banks approve you at those crazy 43% debt-to-income ratios because the loan likely won't default immediately, and they can just package and sell that debt anyway.
Pass the buck.
Exactly. Real estate agents encourage you to stretch your budget because their commission check is a percentage of the final closing price. The entire system is perfectly designed to get you into the house. It is not designed to ensure you can financially survive the house.
And it is heavily reinforced by this massive societal gaslighting. We have completely rebranded financial desperation as some sort of noble rite of passage. People will literally tell you, oh, you're eating ramen in an empty house with no furniture. Congratulations, you're building equity. Welcome to adulting.
It's so true.
We've normalized living in total misery just to hold on to a deed.
And we constantly perpetuate these myths, suggesting you can just budget your way out of this structural crisis. Society pushes the idea that if you just stop buying avocado toast, or if you just work a side hustle on the weekends, you can afford the American dream.
Right, just drive an Uber on Sundays.
But the reality is you cannot side hustle your way into a six-figure down payment when your current rent is already eating 40% of your take-home pay.
Okay, hold on. I have to push back here. Because my entire adult life, I have been told that renting is literally setting my money on fire. The conventional wisdom is that if you don't buy a property, you are throwing away wealth every single month. How can buying a house possibly be worse than throwing rent into a void?
The source makes a brilliant, totally counterintuitive argument to that exact mindset. Being unable to afford your mortgage is also throwing money away. It just comes with extra steps and vastly worse consequences.
What do you mean by worse consequences?
Well, if you run out of money while renting, you simply pack up and move to a cheaper apartment. If you run out of money while owning a home, you face ruined credit, the agonizing process of foreclosure, and the complete loss of your entire down payment.
Oh, wow. So you lose the house and the $100,000.
Exactly. The financial industry sells homeownership as a product, and they've done an incredible job convincing the public that buying is universally better than renting. They profit when you buy. They do not profit when you make a conservative decision to keep your living costs low by renting.
That totally reframes the entire concept of wealth. I mean, real wealth isn't having hundreds of thousands of dollars of trapped equity in a house that you can't even access because you're too house poor to afford a vacation or a medical bill.
Real wealth is having margin in your budget. It's the ability to invest consistently in retirement accounts every month. It's not having to choose between fixing a leaking roof and paying for your kids' tutoring.
Right.
Most importantly, real wealth is going to sleep at night without a knot of anxiety in your stomach. True wealth is financial freedom.
So what does this all mean for you, the person listening right now? Let's bring this right down to the ground. The advice derived from this analysis is incredibly direct. If you are looking at a $500,000 house right now, and your household income is anywhere south of $140,000, you need to stop. Just stop.
Yep.
Full stop.
Ignore the social pressure from your peers. Ignore your friends who are somehow making it work behind their freshly painted front doors because, let's be honest, you don't see their credit card statement.
You never see the credit card statement.
And definitely ignore the maximum limit the bank says you qualify for. Walk away. Keep renting. Look at $350,000 houses if they even exist in your zip code, or just wait. Sit down and run your real numbers. Keep in mind, there is absolutely no trophy handed out at the end of life for being house poor. You are not failing at adulthood because you refuse to financially drown yourself for the sake of granite countertops and a two-car garage.
Absolutely not.
The system has fundamentally failed to keep wages aligned with assets. And sometimes, the absolute smartest, most strategic move you can make is recognizing a rigged game and simply choosing not to play. The real win is making life-altering decisions based on cold, hard math rather than emotional pressure and Instagram aesthetics.
Recognize the rigged game. Which brings us right back to that midnight scrolling habit. If the traditional American dream of a standard 3-bedroom house has been mathematically warped into a financial prison, what if the ultimate status symbol of our generation isn't owning a home at all?
It's a great question.
What if the real flex is having absolute, undeniable control over your peace of mind? What does your new American dream look like?